The first market that you're going to want to pay attention to next week is the pound against the US dollar. It is a big week for data in the UK. We've got unemployment data on Tuesday morning. You can see how that has been falling. If we get another tick lower, that is hawkish, which would put sterling under pressure. Inflation data could increase that pressure on Wednesday if we get a number that's in line with last month's 4%. That is the sticky inflation every economist has been talking about. Even the Bank of England's most dovish member, Dr. Swati Dhingra, talked about maintaining a higher for longer narrative last week. That is sterling weakness. Finally, with balance of trade and preliminary GDP data on Thursday, volatility is set to pick up as traders are trying to figure out how sterling is gonna break out of a 300 pip range we've been stuck in for the past 8 weeks. Now, commercial hedgers, they've been expanding their net short positioning throughout January, so ultimately a new bull market for the pound is in the post. This should give us a reason to buy the dip if we get any downside volatility with all of the data released this week. Technically, we've already probed the top end of our support area created in mid-November last year at 125. You can see the drop down from last week's non-farm payrolls. We've already rejected resistance. That's my line in the sand. Bearish under here, down to a deeper test of support at 124. The second market to look at next week is the dollar against the yen. The carry trade is grinding higher now. The Bank of Japan have clearly signposted a normalization in monetary policy in Japan is going to be so slow, it's going to take 4 years to move interest rates from negative 0.1 to positive 0.1. Very early in the Asia Pacific session on Thursday, that's late night Wednesday in Europe, we'll get the release of the preliminary GDP growth rate for Q4. The market is expecting an uptick in growth, but it's going to have to be a pretty strong number to turn that dollar-yen pair around. This puts the yen in buy the dip territory. You can see that we've pushed above the swing low that gave us our mid-November high. This is where the Ichimoku indicator can really be your friend. The Kumo or cloud has done a great job of containing price on both the 4 and 1 hour timeframes. On the 4 hour, the Kijun Sen has yet to be tested since non-farm payrolls, so that would be a place that I would want to start to manage my risk from. If the early trading next week can hold 149.35, I think it's only a question of time before we're printing this 151.90 high again, and that then opens up a bigger play up to 155 into the spring. The third and final trade I think is worth considering next week is the Nasdaq. We are already up 5.5% on the year so far, and it's not even the middle of February. It's a fairly measured week for data in the US, but it gets interesting from Thursday onwards when we'll print January's retail sales. We're looking for a downtick of nearly 0.5% from 0.6% to 0.2%. This is the kind of dovish data that the Nasdaq has been feasting on as it constantly tries to price in this year's interest rate cuts from the Federal Reserve. The big draw, though, will be on Friday when we get the preliminary consumer sentiment data for February out of the University of Michigan and producer price inflation readings for January. That's the economic data that could provide volatility for US equities. An uptick here would be hawkish, and that would put the Nasdaq under pressure. But every time we've had strong inflation data or jobs data, the dips just get scooped up within the same trading session, so keep your eyes peeled. Traders find it very difficult to be long at all-time highs. That's understandable. There is nothing to the left to work with. This is where Fibonacci is really useful as a tool for projecting targets and areas of resistance. You can see that we broke above the 61.8 retracement on the daily time frame back in May. If we now reverse this round, you can see how strong this bull market is. Bounced nicely off the 23.6 and couldn't retrace to the 38.2. Now, if we flip this Fibonacci over that key swing, we can use our extensions to forecast where the Nasdaq might be headed. 18,914 could be the ultimate destination for this leg. Whilst that might seem far-fetched at the moment, remember that to reverse a market like this, you need to find sellers. And without any price action to the left to work with, those sellers will use tools like this to forecast turning points. And in that sense, it doesn't really matter how far away they are. The proportions are what counts. Now, it's been made pretty clear that we can't expect a rate cut from the Federal Reserve in March. We still have more inflation and employment data to get through. The word, though, is confidence. They need more data that demonstrates that inflation has been contained. We are at the end of an interest rate hiking cycle. The big question, though, is when will that first rate cut happen? For me, June at the earliest. Now, if you're looking to build your trading confidence and your education over the coming year, then come and join us at howtotrade.com. It's completely free to join. We have an amazing new trading academy packed with easy to understand bite-sized videos that will get you up and running in just 28 days. We've got a coaching team with over 30 years trading experience and can offer you one-on-one coaching, all thanks to our partner broker Switch Markets. Don't forget to like, comment, and subscribe to the channel for more on whatever you decide to trade this week. Trade well, and don't forget to reach out if you need any help.